This video will provide a walkthrough to the solution for exercise 18-3, which focuses on calculating basic earnings per share or EPS. Here's the data for our problem. Calvert Corp had 500,000 common shares outstanding on January 1st, 2025. During 2025, the company issued 180,000 common shares on February 1st, declared and distributed a 10% stock dividend on March 1st, repurchased 20,000 of its own shares and retired them on May 1st, issued a 3-for-1 stock split on June 1st, and then issued 60,000 common shares on October 1st. The company's year-end is December 31st. There are 5 requirements for this problem, so let's begin with requirement A, which asks us to calculate the weighted average number of common shares, or WACS, outstanding as at December 31st, 2025. The easiest way to do this most efficiently is to set up a table, where we'll have the event, the date, description, the number of shares outstanding and how this changes over time, a column for retroactive and restatement factors, and then fraction of the year, and then the final column is the weighted average adjustments that takes the total shares outstanding multiplied by the factor and then the fraction of the year. So let's start with just determining all the values in this middle column, the shares outstanding, and then we'll apply the rest later. The company began the year on January 1st with 500,000 shares. The next event happened on February 1st, where the company issued 180,000 shares. Therefore, after those shares are issued, the number of shares outstanding now is 680,000 shares. Then on March 1st, the company declared a 10% stock dividend. So what happens is we simply multiply the number of shares outstanding up to this point by 1.10. That's 100% plus 10%, or 110%. The number of shares outstanding after the stock dividend is now 748,000 shares. Then on May 1st, the company repurchased 200,000 shares, so we subtract 200,000 to end up with 548,000 shares after the repurchase. Then on June 1st, the company declared a 3-for-1 stock split, so we'll take the 548,000 shares and multiply by 3 to end up with 1,644,000 shares outstanding as of June 1st. And then finally on October 1st, the company issued another 60,000 shares, resulting in a total of 1,704,000 shares. Now we'll reveal the last 3 columns, where we'll determine the retroactive restatement factor, the fraction of the year, and then the total number of shares outstanding. The key thing to do here is make sure that we apply any stock splits and stock dividends retroactively to periods before they occurred. If the balance on January 1st was 500,000 shares, there are 2 events that happen after that, the 3-for-1 stock split and the 10% stock dividend. And then because the next event happened on February 1st, that means the opening balance of 500,000 shares was only outstanding for 1 of 12 months. So the relative weight of the opening balance, prorated over the entire year, is the 500,000 shares beginning times the 3-for-1 stock split times 1.1 for the stock dividend times 1 over 12 months is 137,500 shares. Then, after the February 1st issue of the new shares, there were 680,000 shares outstanding. This is before the 3-for-1 stock split and the 10% stock dividend, and because the next event happens on March 1st, the number of shares outstanding were only for 1 out of 12 months as well, the entire month of February. So we take the 680,000 shares outstanding after the issue of the new shares, multiplied by the 3-for-1 stock split, times 1.1 for the stock dividend, times 1 out of 12 months, is 187,000 shares. Then on March 1st, that's when the stock dividend happens, resulting in 748,000 shares. So now this is after the stock dividend, but before the stock split. So we have to retroactively apply the 3-for-1 stock split to this transaction as well. And because the next event happens on May 1st, the number of shares outstanding at this point would be for the full months of March and April, or 2 out of 12 months. So after the stock dividend, there were 748,000 shares outstanding, multiplied by 3 for the stock split, times 2 out of 12 months is 374,000 shares. Then on May 1st, there's the repurchase, leaving 548,000 shares outstanding. This is before the stock split, so we have to multiply by 3. And because the next event happens on June 1st, this number of shares is outstanding only for 1 month, 1 out of 12. So 548,000 times 3 times 1 over 12 is 137,000 shares. Then on June 1st, after the 3-for-1 stock split, there are 1,644,000 shares. Because the next event happens on October 1st, this number of shares is outstanding for 4 out of 12 months. Notice that we're no longer applying any retroactive restatement factors because this is after both the 10% stock dividend and after the 3-for-1 stock split. So 1,644,000 shares times 4 of 12 months is 548,000 shares. And the last transaction are the additional shares issued on October 1st, resulting in a total of 1,704,000 shares. Those shares were outstanding from October 1st all the way through to the end of the year, December 31st. That's 3 full months. Again, this is after the stock dividend and the split, so no retroactive restatement factors are necessary. We simply multiply 1,704,000 times 3 over 12 months is 426,000 shares. Now we add all of those prorated share amounts. We end up with 1,809,500 weighted average number of common shares outstanding. And it's always good practice to double check to make sure all of the fractional years add up to 12 out of 12. Now on to requirement B. Here we're to assume that the company had net income of $3,500,000 during 2025. In addition, it had 100,000 of 8% $100 par non-convertible, non-cumulative preferred shares outstanding the entire year. No dividend was declared or paid for the preferred shares in 2025. So we want to calculate the earnings per share, or EPS, using the weighted average number of common shares from Part A. The formula for basic EPS is very simple. Net income minus preferred share dividends divided by the weighted average number of common shares. So we'll take the $3,500,000, and because in this situation, the preferred shares are non-cumulative and no dividends were paid in 2025, we're going to subtract 0. There are no preferred share dividends to include. We divide that by the 1,809,500 weighted average number of common shares. This results in basic EPS of $1.93. Requirement C is to assume now that the preferred shares were cumulative, and then to calculate the EPS for 2025. The formula is the same, net income minus preferred share dividends over weighted average number of common shares, except now we're going to take the $3,500,000 in net income and subtract only 1 year's worth of dividends, 100,000 shares times the $100 par value times the 8% dividend that's paid. This is an area where students can get tripped up. Even if the shares are cumulative and there are technically dividends in arrears because no preferred share dividends have been declared and paid in the previous 2 years, we only include 1 year of preferred share dividends in the EPS calculation. So the value of the preferred share dividends were $800,000, and if we subtract that from $3.5 million, that's $2.7 million in net income available to the common shareholders. When we divide by the 1,809,500 weighted average number of common shares, the basic EPS is $1.49. Now onto requirement D, where we're to assume the data from Part B, except that net income included a loss from discontinued operations, net of tax, of $432,000. We want to calculate the EPS for 2025 again. Now, in this case, we really don't have to recalculate the earnings per share, but rather we have to make sure that we properly disclose the earnings per share and allocate the basic EPS between income from continuing operations and discontinued operations. So let's start from the bottom up. We know that the EPS on net income is $1.93. We also know that the net income included a loss on discontinued operations, net of tax, of $432,000. So if we take that $432,000 loss and divide by the 1,809,500 weighted average number of common shares, that results in a loss in earnings per share of 24 cents, which means that the EPS on income from continuing operations has to be the $1.93 on net income plus the loss of 24 cents, which is $2.17. Now we can confirm that by taking the $3,500,000 net income and adding back the $432,000 loss, and then dividing the sum by the 1,809,500 weighted average number of common shares. Now on to requirement E, where we're asked this question. Why does the basic EPS denominator use the weighted average number of shares instead of just using the ending balance of shares? Well, the reason for that is because the earnings process occurs continuously throughout the fiscal year, and the capital basis can fluctuate as the company can issue and repurchase shares or engage in stock dividends and splits, as we saw. It's therefore necessary to adjust the denominator of the EPS ratio to reflect the various lengths of time during the year that the different amounts of capital from the different number of common shares outstanding were available to generate earnings during the year. And that's it. Now we're done with this question.